It's like the government finds out what you owe, and then we all have to guess what it is with their rules, and then we hope that we're right. And if we're wrong, maybe we'll go to jail, maybe we won't. No, we really won't.
Welcome to the Physician Sense Podcast, a podcast designed specifically for physicians, offering a breakdown of complex financial topics to help you develop your financial IQ, further your financial journey, and improve your well-being. Whether you're a medical student, resident, fellow, or attending physician, you're sure to learn something new that will benefit your journey. And now, your hosts, Chad Chubb and Tyler Olson.
Welcome to another episode of the Physician Sense Podcast. I am your co-host, Chad Chubb, joined by the one, the only, so good to be back with you, Tyler Olson. We're back. We're back, brother. We're back.
Good to see you. I love talking personal finance with you. It's been too long. We had to get through tax season.
Yeah. So to add context, we Tyler and I just finished tax season, but also review meetings. And then our first podcast episode will be a special guest episode, which we just recorded. So now this is our first one where it's just you and I. The band is back together per se. And it's great. It's great to be back here. We were even sending texts to each other on how excited we were. It's like Christmas morning right now. And we have a fun topic. Because, again, we both reviewed a lot of tax returns. One of my favorite things to do is, I never thought I would say this, but it is truly reviewing tax drafts before they're filed. Once they're filed, you can't really, you can fix them, but it's an amendments pain in the butt. So ideally, you're reviewing drafts. So you and I just reviewed lots of drafts for lots of clients, all these physician households. So I thought, well, I know what I've seen. I wonder what Tyler has seen. What a fun topic. So today's goal is top errors that we saw on physician tax returns while we reviewed them. We each have, I think we were around 5. We might have a little bit of overlap on 2 of those, I believe it was.
Mm-hmm.
But it's a fun topic. Any context you want to add, Tyler, before we get into it? Again, you actually have an official tax designation. I can't brag about that. Any context to add before we get into it?
Well, as we talk about each of these, if it happens to apply to you, don't feel bad, because this is a really complex system that nobody, including the tax professionals, fully understands. It's like the government finds out what you owe, and then we all have to guess what it is with their rules, and then we hope that we're right. And if we're wrong, maybe we'll go to jail, maybe we won't. No, you really won't. If you're trying your best, you're not going to go to jail. But it's stressful and it's very complicated. So we want you to be able to learn from this and realize, hey, there's always going to be gaps for each of us in some way. And I'm serious. Like, among the tax professionals, we're always checking with each other and be like, is this right on this? I need to double check, because like our brains are like a sieve, right? And everything is getting filtered. So don't feel bad, but learn. We hope that you'll learn from this. The first one that comes to my mind that both of us brought up is backdoor Roth errors, right? Because it's such a hot topic, something that everyone's like, oh, I got to do the backdoor Roth. But there's some consistent errors, right? What have you seen? Like, is it the form 8606 not being even filled out? What is it for you?
Yeah, so I actually broke it down into 2 separate ones, and you said it perfectly. So 8606 is always a hot mess. I'm actually concerned on how many accountants are now to the point where they say, well, how would you fill it out? I'm like, well, it doesn't work that way, because I'm not signing the tax return. But it is a form. If you don't have an accountant that is used to doing backdoor Roths, and while they're very common in the physician space, not every accountant has seen them, or they don't know you were doing them, because, most of the time we forget that there's a 1099 that's generated by doing these as well. So the 8606 being a hot mess, or no 8606, which is usually our biggest concern. And then one that we still catch quite a bit, because if your accountant does not know that you did it as a backdoor Roth IRA, your IRA is sending a 1099 that just says, hey, Mr. or Mrs. Accountant, $7,000 came out of their IRA. And remember, you want your accounts to be proactive, but in defense of every accountant out there, there's pretty much a 6 to 8 week window where if they can just maybe get some food and eat, that's they're just trying to stay alive. So they may not be proactive to be like, oh, why'd you take out that 7,000? Oh, I didn't take it out. I did a backdoor Roth. But if that's where it's missed quite a bit. So then we'll go look at line, 4A if we're referring to the 2024 taxes, and we'll see $7,000 there. So you're getting taxed on all of it, which is not what you want to see when you're doing a backdoor Roth IRA. You want to see really a 7,000 and a zero. Usually you're going to see a few bucks of interest showing up over there. But those are the two that we see all the time. And that's for current clients, which is why we always beg every accountant, like, please let us review a draft. It's going to save you headaches. It's going to save the client headaches. But even when we get new clients coming in, so many issues there. And usually that's more the 8606. Although I will say it feels so good when you review like 2 or 3 tax returns and they were actually paying taxes on backdoor Roths for years. And you're like, hey, I don't want to say I'm undercharging you, but clearly I provide a lot of value because look how much I just found. It's like one of those like hidden things. You're like, yes. But those are the 2 forms on the backdoor Roth, but it's very common, very common.
I see that. And then the other one is existence of rollover IRA assets. I've seen it a lot where, and this is wild to me. Well, no, it's not. It's just disappointing is what it is. It's like advisor connected rollover IRAs and Roth IRAs and traditional IRAs, all with the same firm. They're doing the backdoor Roth, and the same firm has rollover IRA assets in the name of the client. And for those of you that aren't familiar why this matters, the backdoor Roth process is, assuming you're maxing it out every year, you put $7,000 into the traditional IRA. You then convert that $7,000 and transfer it to your Roth IRA. That is the backdoor method because there's no income limitation on traditional IRA contributions, whether you take the deduction or not. And there are no income limitations on Roth IRA conversions. So even if you make more money than is allowed for direct Roth IRA contributions, you can take this extra step by going the back route through the traditional IRA. However, this does not work functionally if you have assets, if you have savings in a rollover IRA, some other traditional IRA somewhere else, or a SEP IRA, or a simple IRA. And if you do, then that transaction is going to become, that was not supposed to be taxable, becomes taxable. And so, you got to get that cleaned up before you can do the backdoor Roth process, usually by transferring rollover IRA or IRA assets or SEP IRA assets into a 401k or a solo 401k for those of you that are self-employed. But I've seen that happen, where there are IRA assets, they do the backdoor method, and now they find themselves with it, why was that taxable? And it's because of something that's called the pro rata rule. I don't think we should get in the weeds on that right now, but basically, you don't want to have assets there. And I've seen that quite a bit.
Yeah. I mean, in the simplest way, that's the rule. Like on 1231, you don't want to have any other assets in an IRA, simple IRA, or a SEP IRA. Your Roth IRA is not on that. It's on its own separate island. One of my jokes, Tyler, is I can always tell an advisor that doesn't work with physicians 2 ways. First thing, I see a rollover IRA, because who doesn't love a rollover IRA? Because you get the charge AUM fees on that rollover IRA. Because if I told you to roll it in your 401k, I don't get paid on those assets. So that's my first yellow flag. And then the other one is always, you should put more money into your taxable account. You don't even need to max out your 401k or 403b. I'm like, yellow flag number 2, probably red flags at this point. Mm-hmm. But that's, and again, it's even worse than what you just said, where not only do they have an IRA that they're literally managing the definition of the pro rata rule, but then they're also doing a backdoor Roth IRA every year. That's like you did the Google search on oh yeah, you just got to do this instead. Nope, doesn't work that way.
Mm-hmm.
But if you are doing backdoor Roth IRAs, you got to keep an eye on these things. Even if you're working with an accountant, I love accountants. Accountants have a very, very heavy weight on their shoulders for that 6 to 8 week period when you probably want to ask questions. I always say, if you want to be proactive with your tax planning, do it like now, or even after October, we get through extensions. But even now, they're usually most accountants are cool with it. But you should review these from your accountant. If you're using a TurboTax or something of that nature, you should definitely be double checking. It is very easy to have errors, whether it's to your 8606, which the 8606 isn't as stressful to me as like you're actually paying taxes on line 4A and 4B because you actually did it wrong. And now you're talking, a couple $1,000, if not more, depending on where you are, on a $7,000 tax error, let alone for you and your spouse, significant other. Now we're talking some serious dollars here. And if you don't catch that, you're paying, paying Uncle Sam once is painful enough, let alone twice. So backdoor Roth, that's one that shows up a lot, and it shows up year after year.
Mm-hmm. Yeah. Good call. All right. What's your second one?
Second one's I think it's an easy one, but still missed a lot. And it's just simple missed 1099s. Not like hey, I had a side gig 1099, but your bank account. Your bank account issues a 1099. If you have a bank, you should double check to make sure you don't have a 1099. Now, full disclosure, right? If you have a brick and mortar bank, low rates, not a huge balance, you probably didn't get a 1099. But if you're using the online banks, even with an average balance, good rates, you're probably going to get a 1099. If you have a brick and mortar bank, but you have a large balance on there, you could be getting a 1099. But every year, you should go to any banking institution, just double check your tax documents because those are missed quite a bit. And again, in defense of the accountants out there, they don't know that you open up a new checking account or a new savings account at Ally or Marcus or Laurel Road. Like they didn't plug in all these different places, right? They just said, well, this is what we saw last year. So we assume it's the same this year. Because again, remember, they're just trying to get through these 6 to 8 weeks and survive. And then the other one I was doing there is your brokerage accounts. Now, I think, you always have like your main one through a Fidelity or a Vanguard or a Schwab that you don't forget. But even the little ones, oh yeah, I forgot about that one at Robinhood or that other one over here. They're still issuing 1099s if there was, interest or dividends coming from those accounts. So just double check that because these are ones where a lot of those documents are being sent to the IRS. The IRS says, hey, Joe Smith, Jane Smith, they did have an account at Robinhood, and it doesn't match up to the, what you submitted on your tax on your 1040 to the IRS. These are pretty easy ways to get audited by missing things that are low hanging fruit, just because you didn't double check, or maybe the accountant forgot to double check. But again, not the sexiest one, but that's an easy one. You don't have to be a CPA, an accountant to know, like, oh wow, I just I looked at my Schedule B there, and it wasn't listed on there. I missed that. So that's another one that we see quite a bit.
Mm-hmm. Yeah, totally agree. No notes from me. That's pretty straightforward. Another one that I have come across more frequently, especially as more doctors are put in the position of self-employment. And I don't mean like, hey, I'm going to join a partnership. That usually you're walking into a structure that has some guardrails from like a business management and tax standpoint. But I'm talking about like the EM docs that are primarily 1099 or anesthesiologists. Those are the first two that come to my mind, but there's other specialties too. S-corp election. People hear that phrase and they think, well, I got to get in on that because I'm going to save money on taxes. And it's not that you won't save money on taxes. It's just, I don't personally think that anybody should be DIYing that. With the exception of like the extreme interested DIYer that's just like, I love reading all of the IRS publications and I want to know the details of it.
Exciting.
Yeah, like if that's you, fine. But if you're reading about this on a blog somewhere, or you heard about it at a conference, or you hear your colleagues talking about how they're saving a ton of money on S-corp by doing an S-corp. First of all, there is savings in some cases, but I don't think that it's like night and day. I don't think that it's like, oh my goodness, like you have to do this. And part of the reason why is because you do have some savings that can be captured potentially, but it's a lot more work from a bookkeeping standpoint, payroll, and accounting. So if you're either doing that yourself and you're working more, or you're paying an accountant to do more of the work for you. So it's got to make sense. But the errors that I'm seeing in this being done is in two respects. One, the business is not generating enough income. Like I've seen attending physicians right out the gate, right out of training, set up their business where they've got their PLLC, they got their EIN, like good for them, like trying to create the infrastructure. And like that August, September after graduating, they're like, I'm gonna do this. I want to get into, I'm going to elect S-corp status for the following tax year. And they end up not having earned enough income yet in order to make it work. And it just like, you've got to have like a substantial amount of income, like at least $150,000 at the bare minimum, in my opinion, for it to make sense. And then the second problem is that I see, and this is whether they're DIYing or with accountants who are telling them that they can put down a reasonable salary for their specialty that is not reasonable. I've seen them as low as $65,000.
12 years of schooling, 65,000 buckaroos.
I mean, yeah, like you're in trade, like, yeah, residents are like, well, that's what they pay us in residency, right? Like, it's like apparently my program thought that was reasonable.
Fair.
No, but in seriousness, I've seen this happen where they think like, well, the less I have on my payroll side of income, the more I can have as profit sharing from my business, and that's the portion that gets taxed less. So I'm just going to try to get as much into the lower tax section as possible and take a lower reasonable salary. But like, you cannot be an emergency medicine physician working 1.0 FTE making $65,000. Like, unless you're PGY2, right? Like, so this is just like that is unreasonable. That's what we would call an unreasonable salary. What I have seen is accountants that probably the ones that I'm okay with, that are the most extreme, are the ones that just say cover Social Security, the Social Security income. So at least 150,000. Because after that number thereabouts, you don't get taxed. The 7.65% is a 7 point. I can't remember right now, but the Social Security tax rate goes away for income above that. So as long as you meet that, you're less likely to be scrutinized by the IRS.
Yeah. Well, no, I mean, I think big picture. So another one here, I feel like S-corps can also be abused by accountants telling people at a low income, oh, just add an S-corp, because it makes the relationship a little bit more sticky, even if it's not fully justified. Not the accountants that we know and work with, but again, there's a shady side to every industry, right? Where it's just, again, it's another tax return. It's we've seen some accountants that are also then doing all the payroll for them, so it's more time on there, so more time, more money, so it makes it a lot more sticky relationship. But I agree, you're 150, I usually say 150 all the way up to like 250 is like a base, because it also affects other things, right? It's not, and a good accountant will walk you through this. So I'm like, hey, sure, you're going to save some money by taking these distributions as opposed to salary, but it's also affecting QBI and some other things it's not just like, hey, look how much you're going to save. We always get like TikTok things for this. Clients are like, hey, look, this guy bought a Lamborghini through his S-corp and he pays himself $4,000 a year somehow. I'm just like, yeah, this is tax fraud. We're not going to help you with this. But like, there's always those weird things that come through that they're abusing the rules. And everything with the IRS, right? Like, you have to get caught, but this is not a life that you want to live as a good physician, clearly caring by listening and watching to us about your personal finance. You want to get this built out the right way. You got to, again, the amount of times, Tyler, that we see, they're just taking draws. They're not even taking a salary. It's just, hey, we're just taking all draws. I'm like, the IRS, the tax code legitimately says you have to take a salary, because that's, now you're just, at this point, it feels like you're definitely cheating the system. And sometimes that's with or without accountant, right? They might even have an accountant that's like, they never said anything about it.
Mm-hmm.
And we have others where, they're doing a very low number, like you said, a 65,000, where, in the real world, that's not a reasonable salary. Was it someone that commented on something for you and I, or maybe we found it, where someone like legit said, no, this is the IRS reasonable salary, like chart. And everyone was like, I think it was just on Twitter.
Familiar.
I think the accountants all like started to jump on it, like the accounting Twitter. And they were all just like, there is no chart for reasonable salaries. That's impossible. Just making this up. And in fact, there is no chart for reasonable salaries, but I couldn't agree more on S-corps. I think S-corps are a very valuable tool with the proper setups, but you got to make sure you're also following all the rules and have a good team in place. And maybe that's an accountant, maybe that's your financial advisor. Ideally, it's a combination of two. But yeah, that is another hot spot for errors.
Mm-hmm. Yeah. Actually, I pulled up an old post. Well, it's not that old, 2023. Because I was helping somebody who was new to us. And so I asked Tax Twitter, I said, is $150,000 a reasonable salary for a full-time emergency medicine physician? I don't think so. What do you think? And I had a couple say like, sounds low. Also at that point, how much is being saved with an S-corp since the limit is about 160? And like they're talking about the Social Security portion. And yeah, like a lot of comments about like, it's like, not only is that unreasonable, but you're talking about something that is a lot of work and it's a headache. And like, so the accountants, they know, but then all the doctors are replying to, they're like, no, like that's not of course, they're talking about like how much they're actually being paid. And so you got to think too about the potential for being audited. Like there are rules and you can be like, well, my accountant told me that it's fine. But in the end, if you get audited, it's not going to matter what your accountant told you was going to be okay. You're going to have to explain to other human beings why you're doing things the way that you're doing. And like Chad and I, as like fiduciaries, we go through audits on a regular basis because we're required to. And we have to be able to justify with data and like showing that we're following the rules to be able to answer questions appropriately. And so they'll move on. If you get audited, none of the things that you might think are reasonable or that someone else told you was okay, it's not going to matter. It's all going to come down to your ability to effectively defend your strategy and decisions that you made. So don't take this lightly. And like you can say to yourself all day, well, my chances of being audited are pretty low. That may be true, but if you do get audited, you're not going to give one care at all about the statistics at that point. You're going to be like, I'm 100% being audited now. And that's a terrible statistic, right? So just be smart here. Okay, I'm done.
It's a good one, though. I mean, that is one where you got to make sure you know what you're doing. You got to follow the rules. I mean, I've been doing this for coming up on 14 years. This will be our first year that we file as an S-corp to do all the research. And this is the first year that I hired a bookkeeper because I thought I was organized. I'm like, do numbers all day. This is easy. First year filing as an S-corp, the accountant's like, what is this? I'm like, it's QuickBooks. They're like, yeah, it's QuickBooks. So what does this what do you do? Like have your kid come in here and type in new categories? I was like,
oh man,
felt pretty good. They're like, well, what's this spending? I was like, I don't know. My wife bought something on the Wealth Kill. She went to Costco. So can't do that anymore. I'm like, oh my gosh. So I just hired a bookkeeper for the first time in 13 years because that's how complicated it got. And we do this all day. Like we do this all day. Not the tax side of it, but again, the number side of it.
Right.
So it goes to show you like it gets complicated. You want to follow the rules. You want to make sure you have it organized. But yeah, that's a good one.
Yeah. All right. What else you got?
I'm going to go to underpayment penalties. Underpayment penalties, they irk me. So if you do not pay your taxes properly, I'm going to say balance throughout the year, you can get an underpayment penalty. Underpayment penalties show up on line 38. So if you're following along at home, you want to go check your taxes, go to line 38. I'm also amazed by how many times we see this, Tyler, on a new client. We're like, hey, you had a $3,000 underpayment penalty last year. And they're like, wait, what? How many people don't even know these exist? But so I'm interested to get your point on this, Tyler, but usually on the W-2 side, it's not as common. Now you can certainly get one, but usually there it's not. If you're only W-2 income, we don't see it as common. Anytime we start to see like large chunks of K-1 income, 1099 income is definitely the main culprit here. But when you pay your taxes throughout the year, let's just say you are mostly 1099, you got to pay the IRS equally throughout the year. And how do you do this? Well, you got to make these things called quarterly payments, quarterly estimates. And there's one for Q1, Q2, Q3, Q4. If you don't pay them evenly and they're weighted, you can get this underpayment penalty. This is where you most commonly see it. And this is one of my biggest pet peeves because I feel like this is like an accountant's job. Like you should not have to pay penalties on your tax bill every single year, but yet it happens all too often. So you want to make sure that you don't have anything listed on line 38. You want to make sure this is dialed in. This is also a good time of year. I would say for at least for our firm in summer, we like to go through W-4 updates with clients. So it's like by the time this podcast goes live, this YouTube video goes live, it's right in there with summertime. Good thing to check in, but you should not be having that issue. And if you are, you need to either adjust your W-4 to withhold more through your actual W-2 paycheck, or even as a W-2 physician, right? You can still pay quarterly estimates. You can balance that out by making those quarterly estimates. So again, two things here, Tyler. I'm amazed how often we see it. And the second one, I always say like 1 year here, 1 year that's off here or there, understandable, but it should not be a consistent theme. And I am amazed by how many prospective clients we get where they actually had what I would label as a pretty substantial, like if it's a couple $100, that's still, you shouldn't be paying that, but maybe it doesn't show up on the radar as much. But usually we're seeing thousands of dollars and these rates have gone up quite a bit. A few years ago, I think the ongoing rate was like a 3% issue. Now it's the whole way up to 8%. So now the numbers are jumping up where you can easily see a couple thousand. But am I being over dramatic or do you see this a lot?
No, that's pretty common too that I've seen. And yeah, the current rate for that I've seen, actually just checking the IRS site right now. Looks like it's 7%.
Okay, 7. All right.
So at 2024 was 8%.
8%, yeah, that's what I thought. Okay.
So it's come down a little bit. So yeah, I've had some physicians tell me that they thought that as long as they got all the payments in by the last quarterly payment due date. Mm-hmm. So the due dates are April 15th, and April 15th is a double whammy because not only is that the due date for the prior tax year. So like, for example, last month, April 15th, if you owed anything for 2024, it was due at that point, as was your income for January, February, and March of this year. So April 15th covers those 3 months. June 15th covers April and May. September 15th covers June, July, and August. And then January 15th covers September through December. And that, like the concept that like, well, I'll just throw it all in at the last one, January 15th, to cover the whole year. I mean, yeah, you're stopping the bleeding at that point. But when you have to input the dates of when you made payments, and you can't lie about that because they know when they got your money, then they will apply, they'll calculate a penalty based on the underpayment relative to like when income was earned and when it should have been paid, because they're not going to believe that you made $350,000 during the month of September through December and made nothing January through August. So that's not going to work. So that's definitely an issue that I've seen too. And it's like, it can be frustrating, especially for those who have are coming out of the like forgivable loan cloud, mm-hmm. like where they get charged income tax on income that they earned 3 years prior if they didn't know that was going to happen. I see that a lot with the guaranteed salary scenario, mm-hmm. for new physicians. So it's not easy to navigate. But like one thing, like you mentioned about doing W-4 reviews now, also having reviewed the 2024 tax return, that tax number that you owed for last year can function as a safe harbor for this year. Like it's what is it? It's 110%.
Yep, exactly.
110% of last year's tax due. So that's a good number to go off of. Oh, and mind you, for those of you that are completely on W-2 income, this does not, like this, the quarterly payment stuff doesn't necessarily apply to you unless you've got some side income. What Chad was mentioning about the W-4, that does apply to you. If for some reason, and this is so common with like when doctors, they like, well, I get like $35,000 from the medical school, and then I get, $215,000 from the university, and they've got multiple W-2s, and they're not talking to each other. So that's why the W-4 analysis deserves attention, because that still, even if you're not self-employed, you can still get hit with these underpayment penalties if not enough tax is being withheld from your paychecks.
Yeah. And the safe harbor number makes it a lot easier because you actually know last year's tax number. The hard part is technically you can also avoid underpayment penalties by hitting 90% of your current year's goal. Hard part is that's a moving target, right? That number literally is changing throughout the year. But sometimes you have to always go to the 90% rule, because if you had like a crazy year where your income was through the roof for whatever reason, you just retired for whatever reason, you got a huge payout, or you got some type of other contribution that came in and your income's really high, you probably don't want to use 110% of last year's number because your taxable is not going to be that high. So you got to also track it as you're going forward towards the end of the year and things of that nature. And they're weighted. So if your game is to play the catch-up game, do it the opposite way. Make a massive payment for Q1 and then fine-tune it later on Q3 and Q4, because you're going to do better on that waiting at the start of the year as opposed to waiting later. So if you had to pick one, and that's even, I would say for the physician community, it's even harder because how many K1s are out there. A lot of our physicians, I think it's more about a 50-50 split. We're about more than half now, though, right around there, still files an extension every year. So then at that point, you're definitely missing Q1. Q2 is there. I mean, you could be getting close to Q3. So for our clients that are usually off a little bit, we're usually saying, hey, I'd still put something in there for Q1, Q2, at least to get some dollars on the board, and then we'll fine tune it. But again, it's just a pet peeve of mine. You should not have underpayment penalties. 1 year here or there, I get it, but it should not be a consistent issue. Yeah. And I don't think we have an older demographic here, but another area we see issues is like clients that when we're doing Roth conversions in retirement, again, that creates a tax bill. That tax bill can cause underpayment penalties. So another area where it's good to understand how quarterly payments work. I think it's really important for the overall taxes going forward, but don't have underpayment penalties, at least not consistently.
Yeah, amen. Were there any others, or did that cover it?
You had one more that you noted earlier that I thought was a good one, and I think it's a good one to end on: the state taxes.
Oh, yeah, that's right.
I got you.
Yeah, thank you. So, yeah, how often are you physicians moving across the country, and you'll have income in one state, and then you'll have income in another state? Or you'll have income in one state, and then you'll continue to have income in that same state remotely, but then you're moving to a state that knows that you moved there. And like whether or not your tax, that actually changes your tax liability, every state has its own rules about when you have to file a tax return. And I'm talking about you, California. That's right. They're not the only ones, but if you're moving from one state to another, I think that behooves professional advice. You got to make sure that I don't, because I've seen TurboTax make so many mistakes here. Just because it goes through a process of asking questions, and it doesn't ask all the right questions, because it's just some software. But I see that a lot where doctors they didn't fill out their state income tax, or they didn't even know that they needed to. It's not for a lack of effort.
No.
It's just that because they don't remember where they were earning income or what qualifies as earning income in what state. It's complicated. So you have to take the time to make sure that you're filing your state income tax returns.
Yeah, and this one always when we were in Philadelphia, because you could be a physician in Philly and live in Pennsylvania, you could possibly live in New Jersey, could possibly live in Delaware. So not only was it a state tax thing, and there's reciprocal agreements with Philly and New Jersey, but Delaware's in there, and then you get into local taxes. We've seen clients where they move, but they're still in the same hospital system per se, but they forgot to say hey, we moved from the Philadelphia suburbs or Center City, Philly to the suburbs of New Jersey, and then they don't update payroll properly, right? So it's actually not withholding, or they're withholding for states that they don't live in, and we're well, at this point, hopefully it's not a massive number because we're talking about state taxes, but now you get into a point where you're not going to get that money back until you file your to go through the state and say hey, give me the money back. It's going to be a disaster. So now you got to wait till you file to get that right. So they don't get as much attention because it's the smaller tax bill compared to your federal tax bill. But you definitely want to keep a close eye on state taxes. You want to keep a close eye on if you are in one of the areas that have local taxes. That's one of the nice things about Florida and Tampa. It was my joke when we moved down here was I went from 3 quarterly payments down to 1. It's been fantastic. But you got to pay attention to the state and your local taxes. Yeah. But it's a fun topic because, when you said at the start there, Tyler, like, hey, don't be discouraged if one of these is on your list. I'd say, like, I'd take it the exact opposite way. We uncovered it because if you didn't figure it out, you didn't hear about it in this one, especially backdoor Roth, very common in the physician community, underpayment penalties, state tax, all of them. I mean, all the ones that we covered. That's one that if you didn't hear it today, it could be an issue going forward. And these are very common mistakes. These are the most common mistakes that Tyler and I saw with very smart clients that have a good financial advising team. Most of them are not using TurboTax, right? They have good accountants too. And we're still seeing these types of issues and these errors. And this time of year, you'll see a lot of other individuals that are like Tyler and I that work in the physician community also releasing topics of this. And it's amazing how consistent like my list is to Tyler's list, to another advisor, to another advisor. So we see quite a bit. So double check your tax return every single year with an accountant, without an accountant, with your financial planner, without your financial planner. But you want to make sure you're getting this thing dialed in because it's a big bill every single year. You got it for the rest of your life. So as I always joke, happy to pay Uncle Sam. We just don't want to leave a tip for Uncle Sam. That's the key.
There we go. And given that we're midway through the year, just want to remind everybody, this is definitely the time to be doing tax planning for 2025. Be proactive. So if you're already out of training, you're in the routine of of your job, you might have a good layout of like what needs to be done, but there might be things to uncover that you don't know about. Invest the time to know what sort of ways you can reduce your lifetime income tax liability. And then for those of you, I am thinking a lot about those of you that are in transition out of training. There are some important things to note, like the ones that we mentioned today, but also ways to best use this opportunity of higher income that's about to flood your checking account. So stay alert, make the most of it.
Well said. All right. Good tax topic.
Yeah, it was fun. We'll see you soon.
Catch you on the next one.
This information is for general purposes only. This information is not intended to be a substitute for specific professional financial or tax advice, as individual concerns vary. Please see a financial professional, CPA, and/or an attorney in regards to your own individual situation. Wealth Heals Advisory Services and Financial Planning offered through Vicus Capital, Inc., a federally registered investment advisor. Olson Consulting, LLC, offering advisory services and financial planning, is a state-registered investment advisor.